As you know, uncertainty around COVID-19 restrictions continues to linger, which is why we've partnered with RSM, who will be discussing your business recovery plan. Our speakers today are Andrew Sykes, who is a Director of Business Advisory in Canberra at RSM and a Chartered Accountant with over 20 years' experience. We also have Greg Dudley with us today, who is a Partner and National Head of Restructuring and Recovery at RSM and an accountant with over 25 years' experience. So, once again, thank you all for joining us. Greg and Andrew, I'll hand over the reins to you.
Thanks very much, Kate, and thanks very much for Victory Offices for this opportunity. But more importantly, for everyone on the call, thank you for investing your time today with Andrew and I to allow us, or probably to be realistic, should I say Andrew, to commence the discussion around the risk and value drivers of your business. Whilst we're all experienced to differing degrees incredibly uncertain and challenging times at the moment, at RSM we look at this as an immense opportunity to work with you to reimagine and reshape your business. We think we can work to get the business that you want it to be rather than the business you currently have in this environment. In this regard, I'm a massive fan or proponent of the control your own destiny mantra, given what I do is in my part of my normal day job as a liquidator, where I see a lot of people who can't control their destiny. I've always found where ownership has an acute internal awareness of their business's strengths and weaknesses, as well as an awareness of their opportunities and threats, and then they put the requisite time into planning to utilise this information, the end result is that you get a much more sustainable and financially rewarding business for owners and all stakeholders. So in essence, right now, all businesses need to support other businesses to survive and thrive. And so there's greater levels of flexibility in the business community to work together practically rather than contractually. And I suspect you all understand what I mean there. So really, this is an opportune time to take advantage of this mindset and position your business for future upswing in economic activity when we get through all this. Now, all that sounds great, but the first step in that process is to be fully aware of the risks and value drivers of your business before considering what tweaks and changes you need to make to take advantage of current mindsets. I'll hand over shortly to Andrew to work you through a tool that makes this process easier and allows us to move forward towards the full What's Your Plan discussion. And to add to Kate's introduction, by way of a brief intro, Andrew's an expert in business advisory. He loves to help his clients grow their business and their personal wealth. And I'm along as I'm okay at helping clients protect their assets when they've accumulated them. So that's for a later discussion. So I'll pass it to Andrew to get on with the guts of the talk.
Thanks for that, Greg, and once again, welcome everyone this afternoon. Thank you for taking your lunchtime out to hear a little bit about growing your business and business planning. There's a great saying, and that's don't waste a good crisis. We've got a crisis in business at the moment, and now is an ideal time to plan and change your business and continue to grow it and strengthen it using this crisis as a platform for it. Today we're going to have a talk around that, and we're going to have a look at a little bit on change planning, what drives change, what stops change, how we can develop a framework for both the development of strategy and its execution, helping you to set your vision, and also some valuable tools that can help you create real change in your business. We're going to start with that by having a look at why does change work, or why doesn't it work? Business is conditioned to inertia. Change is not its natural state. Think for yourself how good you are at driving change in your own business. Most business owners aren't great at it. And the DVP formula helps us to explain and to quantify why that is the case. There's some McKinsey research out there that shows that about 70% of corporate change programs fail. The main reason in our experience that we see that is low dissatisfaction. We often see businesses have a really good plan and they have good vision, but they're not dissatisfied enough to do anything. The old saying, if it ain't broke, why fix it? So if we turn that into a formula, we have our DVP, which is dissatisfaction multiplied by our vision and multiplied by our plan. And if we went through and rated each of those factors out of 10, and then we divided it by 1,000, we'd end up with a percentage score. And you can see from the example that I've got up there that we've got 9 for vision, 10 for plan. So we've got a business that's got a great vision and a great plan, but very little dissatisfaction. That ends up in a score of 27%. And in our research shows that unless you score over that 60 to 70% mark, you're not going to see change in your business. So it comes down to dissatisfaction can be driven by a couple of events, and we are seeing a lot of plaudits now for businesses that are changing and adapting and evolving rapidly. That's because coronavirus and lockdown is a massive increase in dissatisfaction. We quite often caution businesses that we work with that nothing is as permanent as a temporary solution. So once we put a system or a process in place, it tends to become very permanent. How do we drive that change? That change can either be done slowly, or what we have recently, massive changes in our operating conditions. And as I said before, let's not waste a good crisis. So now we should recognize in our businesses that it is very fertile ground for change. But it's difficult. There's a few tips that we can give you to help increase the chances of driving change in your business. It starts at the top. So whoever is the leader in the business needs to lead and not manage. So that's around setting an active example around change. Importantly, choosing those to come along with you, the right people, and empower them. And recognize that any change process is continuous improvement. Ultimately, all businesses are organizations made up of people. So it is the people who will drive that change for you. People need communication. So you can improve your change by communicating regularly. We also find that having a range of business tools to help you structure your thinking will start to filter out what's important and what's not important. If we look at the first of those tools, and it's a really good tool, it's called Pareto Analysis. And in the late 1940s, a Romanian-born American engineer and management consultant, Joseph Uren, suggested the principle and named it after the Italian economist Wilfredo Pareto. Pareto had observed in the 1900s that 80% of income in Italy went to 20% of the population. And Pareto later carried out some surveys and found that similar distributions applied. So this tool is one that we use to sort out the vital from the trivial many. So we use it to recognize that 20% of what we do drives 80% of our results. So if we're business strategists and planners and change drivers, 20% of what we do is going to drive 20% of what we achieve. By recognizing this, it helps us keep focus on what's the important things in our business. There's some really good examples of this 80-20 rule, and that's 80% of your profits will probably come from about 20% of your customers. 80% of your problems will also come from 20% of your customers. 20% of your products will make up 80% of your sales. And when you look at your staff, you'll find that 20% of your staff will probably take 80% of the sick leave. So it's a really handy rule to use in business, but importantly, when we're looking at change management and strategy and planning, it's around saying what's the most important things that we can do. The second thing we want to look at, the second personal tool that we can use, is Locus of Control. As the environment around you changes, you can either attribute the success or failure of your business to things that you have control over, or to forces outside of your influence. The orientation that you choose has a bearing on your long-term success And this orientation is known as your locus of control. The study of this dates back to the 1960s with an American Julian Rotter's investigation into how people's behaviours and attitudes affected the outcomes of their lives. So the locus of control is the degree to which people believe that they, as opposed to external forces, have control over the outcome of events in their lives. Individuals with a strong internal locus of control believe events in their life derive primarily from their own actions. The most common example we see of this is when receiving exam results. People with an internal locus of control tend to praise or blame themselves and their abilities. People with a strong external locus of control tend to praise or blame external factors. So if we look at an exam result, somebody who has an internal locus of control will say, well, I shouldn't have gone out on the weekend, or I should have studied harder. Those with an external locus of control will say, well, the teacher didn't run the course well, or the exam was on things that we didn't study. So this really applies in your business, and whether you say that you have control of what's happening around you and you can change things, that you can control how your business operates in the environment, or you will float along with and be controlled by that environment. When we move on to developing a business model, the business model is the heart of the strategy that we want to adopt. So your business model is very different to your business plan. Your business model is a description of how your business makes money. It's an explanation of how you deliver value to your customers at an appropriate cost. So it'd be great if you could sit down and actually document what your business model is. When you do this, your business model should fundamentally answer three questions. Who is your customer and what do they do? And it's who is your customer, and what do you sell? Who is your customer and what do you sell are very related and can be quite often misunderstood. A really good example that's often given is the transatlantic shipping operator of 100 years ago. Big, fast, beautiful ships that carried passengers between Europe and America. The owners of these big ships defined their business as shipping. As logical as that would look, because they were operating ships, it locked them into a worldview that the future was about bigger and faster ships. So these companies got involved in innovating to create bigger, faster ships, spending their research and money on buying those. And it led them to ignore a disruptive technology, which was the aeroplane. How would it have been for them if they had defined their business differently? Not as being in the shipping business, but the transportation business. Things might have looked very different for them today. They might have bought planes and knocked one out of business. So defining what you actually sell and the business that you're in and who buys it are incredibly important. And then it's around defining the valuable formula as to how you make money. Most successful businesses, or the most successful ones that we see, are the ones that actually take the time out to sit down and write out these things. So the valuable formula in your business is, how are you different from others? What are your strengths and weaknesses? And what are your core competencies? And importantly, what are your goals? Once you know these things, you can start working towards a strategy. Before we talk about strategy, though, I will say strategy without execution is virtually worthless. There's no point having great strategy if you can't execute it. So the purpose of the strategic planning process that we go through is not to create plans, but to change the way we act and think about our business. It's not the plan, but the action that matters. The value of any strategy is how well it's executed. So what do we need for that successful execution in our business? If you look at the quadrants in front of you there, quadrants 1, 3, and 4 all lead to failure. So obviously, if you have poor execution and poor strategy, it's not going to work. But if you have poor execution and poor strategy, equally, it's not going to work. So to be successful in this, we need to have great execution or effective execution, great strategy. So we need to know where we're going, and we need to know what steps we are going to put in place. That sounds relatively easy, but it is difficult for most businesses because, as the military strategist Helmuth von Moltke said, no battle plan survives contact with the enemy. And this means that when the battle plan meets the real world tends to win, or at least changes the plans we make. So to be successful in our strategy, we need to be flexible, adaptable, and be willing to move with it. But more importantly, we have to begin with the end in mind. So we have to have a vision of where we want to go to. Having a vision helps provide a sense of purpose and direction for your business. Your vision will help you define your short and long-term goals and guide the decisions you make along the way. One of the most successful business people who I've ever worked with said at the start of every single day he would get in his car on his way to his office and he would say, what am I doing today for myself, my family, and my company to achieve my long-term goals? Those long-term goals being the ones that he set in his strategic planning vision sessions. So what we want to be doing is saying, well, where do I want my business to be? And once I've worked out where I want my business to be, we then start to look backwards from the vision to the present day, and then we can put steps in place to do that, to achieve that. So what is vision? What we do know is that you should make your image of the future and clear as powerful as it can be. Take in mind, I'm an accountant, and I think they understated my experience by 10 years. I'm actually older. It's 30 years of experience. And what I've seen in that time is that vision in numbers works. So vision, ideally, should be set clearly. And you can start setting your vision by saying, do I have a clear 3-year vision for my business? As in, what do I think my sales, my profitability, my cash flow, my number of staffing, those clear, concrete things that we can aim for, the numbers, what do they look like? You can then start to question, how regularly do I implement those strategies? And most importantly, when you're setting your vision, is do you want to do something different? I'll take you through a framework now that will give some more importance to that idea of having a vision for your business. So we use a process, and it's called the now, where, how process. And this process asks 3 key questions that need to be answered in developing a plan. And it is the now, what is the current situation? We then ask the where, what is the destination? And then we circle back around and we work out the how. Reviewing these internal, the now will help you review internal and external factors to draw a line in the sand and understand where your business is today. This can then be used as the base from which to measure future improvements. What we do caution though is assessing where you are now can often lead to jumping in and fixing problems, or lead straight to the how part of the process. The problem this can cause is that you may be fixing the easy things or the most visible things. Ideally, where you want to be spending your energy on changing your systems or processes is the ones that are going to give you the greatest return. That's where the where part of this process will solve it. So if you look at the example I've got up there, this business, the now, is $1 million turnover, 10% profit with 6 staff. The where, we want to move to $1.5 million turnover. We want to have a 20% profit, and we want to have still 6 staff. So what that says to me is higher sales, higher profit, higher productivity out of the 6 staff. If this business can achieve it, it will go from making $100,000 to $300,000 off the same resource base. So that's the vision that has been set for this business in numerical terms. Once we've done that, the how becomes relatively easy. The how is just what do we need to change in the short term and the long term. This is a continuous cycle. So we look at the short term, we look at the key issues in the implementations. We say, then how do we get there? We then look at our strategies and where do we want to be once we've got there, and then we circle back around to looking at those key issues. Business planning and improvement is a continuous cycle that keeps on moving, because as you achieve your short-term goals, and there is a lot of research around to say that short-term goals, 6 to 12 months, are the ones that are really effective because you can focus on those. It becomes a continuous cycle to achieve your long-term goals, because you should also have a vision of your business well into the future. So using this framework, this matching our strategy to execution, means that we will actually start seeing change in our business. What kind of changes are we going to start looking for, and what are the practical tools that we can start using? The first change that we are going to want to look at is growth. So when we look at growth and we say we're going to plan for growth, there really are 4 ways that we can do it. We can take our existing products and we can move into new markets, or we can increase our penetration into existing markets, or we can develop new products for the same existing or new markets. So depending on what kind of business you're building, your growth strategy might include aspects like adding new locations, investing in customer acquisition, franchising, expanding your product lines, in particular at the moment, selling products online across multiple platforms. One of the best growth strategies we're seeing at the moment is existing businesses setting up multiple presences online to allow them to have the same distribution and product source, but multiple pricing strategies across their customer base. Your particular industry and target market will influence decisions about this, but it's almost universally true that new customer acquisition is the driver of those growth strategies. Once you've determined your growth strategy, it's up to your pricing strategy. Pricing is one of the most misunderstood and misapplied areas in small business. So what you would ideally like to do is determine the relationship between price and demand. Now that's going to be driven by 5 key factors. There are plenty more, but the 5 key ones we see is the unique value that you can demonstrate to your customer. The higher the unique value, the more pricing power you have. There's also an understanding of what other substitute products are available in your market and how much you can price something before a substitute product will start to erode into it. And the difficulty of comparison. How easy is it for your customer to compare your product against others? When we look at internet-based business, this is a real problem, because internet-based businesses operate in a world of near perfect information. Big companies like Amazon, for example, operate on a near zero profit margin philosophy, because you can compare the price of a book on one site versus the price of a book on another. If it's easy to compare, it does get very hard for you to have pricing power. And then looking at the end benefit to your customer and your price versus quality. So when we come to business, and where I say it's misunderstood or misused, is that the manipulation of prices both upwards and downwards gives enormous potential for increase in profits for business operators. There was a famous study by McKinsey that determined that for most companies, a 1% increase in price would generate an 8% increase in profit. And I do have an example later on where we look at some small changes in business driving big changes in net profit. So if you could increase your prices by 1%, you could probably get an 8% increase in operating profit. But the key thing to remember with pricing is that you have to make the right move at the right time. This requires an understanding of how price changes will impact on sales. For example, if a small decrease in price results in a disproportionately high increase in sales, decreasing price may be worthwhile for a while to attract new customers. This is where a carefully considered pricing strategy becomes useful. Price is one of the most important differentiators between customers choosing you and also them choosing someone else. Market segmentation is also critical in understanding and planning your business. So market segmentation is that process of dividing your market of potential customers into groups or segments based on different characteristics. It may sound complex, but it's actually pretty easy to do, to go out and have a look at your customer base, download your customer list from MyOb or from Xero, start looking at some different characteristics and create some segments of customers who respond similarly to different either marketing or pricing strategies, and also share similar traits. If we look and go reflect on 1% increase in price gives us an 8% increase in profit, understanding your market segmentation allows you to do that differential pricing. So an example I'll give on that is that you may want to segment your customer base by length of sales relationship with them. So longer term versus shorter term clients. You may find that your longer term clients are less price sensitive than your shorter term clients. And that's because they've been dealing with your business for a longer time. They have a relationship, they value service and quality and things other than price. That's fantastic, because what that may allow you to do is set a lower price for new customers and then have a strategy to increase that price over time. So you can actually make more customers more profitable over time if you understand a bit about their segmentation, why they're dealing with you, and you start identifying some of those characteristics of your customer base. So that's looking internally. I'm sure some of you have looked at your competitors and wondered, well, why are they doing so well? Why have they got a new fleet of vans and I don't? Why are they getting customers when I don't? It's really useful to look at that, because then what we do is take that and do a competitor analysis. So if you were to say that in business you learn by your mistakes, it's far cheaper to learn from your competitors' mistakes than your own. So taking the time to do a customer analysis, and the way a competitor analysis, the way we like to do it is look at a particular business and say, well, these are the real drivers of it. And we come up with about 10 different attributes of what drives success in a particular business. We give it a weighting, and then we go out and analyze what we think of us most importantly. That gives us a benchmark where we can say, well, we want to improve in this particular area, or we're happy with our business in this particular area. And then we go and have a look at our competitors. And an example there is that we've said that, you know, product weighting, it's not a big weighting, it's only a small 10 out of 100. We've weighted ourselves as 5, but we've rated our competitor D as number 10. So competitor D is our strongest competitor. If we've identified that, we can go and have a look at what's the difference between competitor D's product and ours. What are they doing different in leadership, and what can we learn from looking at their business and compare it to ours? So done properly, competitive analysis will give you plenty of quantitative and qualitative data to back your own business decisions. So it's not talking about cloning your competitor's strategy or coming up, you know, copying what they're doing, but it will help you to develop or validate your own unique business proposition, prioritize what you need to do in your business to achieve success. It will help you benchmark. You can understand where they're spending and you're not. But importantly, it can also, if you can analyze the right competitors, it can help you find gaps in the market that aren't being fulfilled and help you grow your own revenue. So it's an incredibly important part of business planning. I've spoken today about a few things, and quite often when we get into business planning and strategy, it can be overwhelming to change our business. I made a comment earlier on that big goals, those 3 to 5 year goals, have their place. But where we see most success is when businesses decide to change and they start to change today. Rather than saying, I'm going to change tomorrow, we start to change today and we start picking small things in our business that can make a difference and yield results over a period of time. So when we look at that business planning timeframe, ideally for me, I can only work on 1 to 3 things at any one time. Most people are the same. So if I said within my own business, I could work on 3 things over a 3 to 6 month period, I can start to bring in small changes. Big changes don't tend to work unless there is a real crisis in your business, and we've seen that now. But we think we're over a lot of the crisis period, so now it's time to take advantage of that and put in some good business planning and some change. So when I say small changes can make a big difference, I've done up an example there. So we've got a small business that turns over $1 million a year, and it has cost of goods of 61%, and so it has a 39% gross profit. So it sells $1 million worth of goods. They cost $610,000, leaves it with $390,000 in profit. And then it has 25% overhead, so it makes about 14%. Not unusual characteristics for a small business. If we went through that business and we could make some small changes that increased sales by 5%, decreased our cost of goods sold by 5%, and decreased our overheads by 5%, we would actually drive a 66% change in business. So we don't need to drive our revenue up by 20% or cut our costs by 15 or 20%. If we can make percentage changes of 3, 4, 5% in those areas, they really do reflect in a change in our bottom line. So when I talked, how do we actually do this? What do we actually do with this? What we do is that ideally our process is a 1-page plan. So you pick an area within your business. So you do your full strategic plan, and we'll give you some links to get that done at the end. But in those particular areas, if you want to work on your business, you say, okay, what does that look like? I've now got sales of 1 million. In 6 months' time, I want to be at 1.8. So it's a big goal. It's a big increase. But I want my profit to go up to 12% as well. So I want a little more sale, and I want to get 18% or $15,000 average sales. What we do is we define what our strategies are. So when you go through, and we're going to give you some links that'll help, that link to our software to help you write your own business plan at the end of this. Pick out an area at a time to work on it in 3 to 6 month blocks. So we need to pick what our strategy is that we want to work on, pick our action plan, and critically, the timing. Who do we want to do what, by when? And then we break that down into as much detail as we need. But pick those small building blocks. As I said, small changes can drive big differences in your bottom line. And it's a multi-layered approach in small to medium business. So there are a few tools and a few tips and some discussion on business planning. If there are anyone who has any questions, please feel free to enter them in the Q&A box. We've got time at the end of this to answer questions from people. We do have some next steps though. So as I said, and one of my support team will send you a link in a sec. We do a free risk and value driver assessment. We have a business planning workshop that goes with that, and it generates a business plan. So one of my support team now will send you a link. I'd ask you while you're on the session, if you could just click on that link and just make sure that it works for you and goes through. If I'd ask you to do that now. If that doesn't work, just pop it in the Q&A and one of the team will sort it out. Then our risk and value driver assessment is a list of questions where it asks you specific questions around your business. And you get to identify in there how you feel about that in your business, how it impacts on you, and what you believe the relative importance of that is in your business. So you answer the question and the relative importance. I hope everyone's had a chance to click on that link. As I said, if it doesn't work, just pop a note in the Q&A and we'll get you some assistance. That link, once you've got that, you get to attend our automated, we do run an online business planning workshop. The business planning workshop then allows you, it takes about an hour, hour and a half. It allows you to set the plans within your own business. It does you look at your SWOT, you compare yourself against your competition, you come up with the plans that you believe will help you drive your own business. And as I said, there is no charge for that. It's a service that RSM provides to businesses out there. So if you would like to be involved in that process, click on the link, complete the questionnaire. We'll send you back the initial report, and then we'll send you a link to the business planning workshop. So that's our presentation for today. We're more than happy to take any questions. If anybody would like to enter a question in the Q&A box.
Thank you so much for that. There are a couple of questions, it looks like. Ben Vokler has said, thank you, it's been a really interesting session. In your experience, what do you see as the 3 most common areas that businesses should look at? It sounds like pricing and financial modeling are 2 areas.
Yes, look, I would really agree with that. The financial modelling is really understanding your accounts and the drivers behind that. So when you get your P&L, analysing that and understanding what drives behind each particular part. Pricing, I think, is incredibly important because pricing drives your revenue, which is the lifeblood of any business. If you can have the best business and best strategy in the world, but if you don't have revenue, it's no good.
I'd add in, if I could, Andrew, from my end, seeing people in a bit of distress, pricing, it's working on your business rather than in your business. In small, medium enterprises is a key, and that's what all this planning process is about, is working on the business. But also in respect of pricing, it's making sure you're not following market without making that an informed decision.
Yeah, I'd agree with that. And if you work on those other things, so the third part, sorry, I would put in a third part as people, because you need people in your business to do it. All of those wrap together, and if you get the strategy behind those financials, it allows you to drive them. So if you've got a good motivated sales team, or for example, I had a client who wasn't doing well in sales, and we went and had a look at their sales team and how they would present, and we asked the salespeople not to have a cigarette just before they turned up to someone's house, so they didn't smoke, and we developed a script for them, how to talk, etc. Once we got those people on board, their sales went up. So I would say it is pricing, financials, and people, the key drivers of business.
Yeah, absolutely. Now, before we finish up, I'll just ask if anyone else has any other questions. Oh, I've got another question from Ben. He says, cash flow is what kills a lot of businesses. Any other tips for how a business can manage cash flow in this difficult time?
Greg, is that one you've got some views on? What are you seeing out there?
It is, and it probably comes back to my lead. I mean, clearly, major focus at the moment, and I'm sure you're all doing it, is take advantage of every government stimulus measure. And a shameless plug: if your accountants aren't getting you all of that, come and talk to Andrew and his team, because there's a lot of cash flow boost to be taken advantage of. And then it comes back to the other point I made. All businesses are in a cash flow crisis at the moment, so I think it's all about communication with your fellow people in your supply chain and your stakeholders, and an understanding that probably everyone's in the same boat and they can't pay everything, but if you can clearly communicate and pay portions and get money circulating around the business community, we're all in it together and we'll work better. Now, and that's where I came back with it. There's contractual requirements and there's practical requirements, and so really it's a simple bit of access as many government stimulus as you're going to get, and that's going to be federal, and there's going to be more and more state-based stimulus measures coming on board. So be looking out for them, and communicate with all your stakeholders and try and get to a reasonable position, because I understand Ben's question. If he's not getting paid, then he can't pay his suppliers, and they're not getting paid, so they can't pay their suppliers, and we all go down this vortex. We don't want to go down a vortex. We all want to be, if we can't get it all around, get some of it around.
Yeah, and I agree with that. And it's about controlling what you can control. So reflecting on that, in that locus of control, let's look at what we can control in our environment. We recently have been with a couple of businesses. We've asked them to talk to their customers about getting 50% up front. Rather than everything on an account, and that's costing them some customers, but it's costing them bad customers who aren't going to pay them anyway.
And even to jump in further on that, Andrew, just thinking about your model and with some of the planning and how much a difference of 5% increase in your sales or 5% decrease in your cost of goods. Right now, Ben's right, cash is king. If you can pay people early, I'm sure you're going to be getting a 5% discount. So you might be able to use some of your stimulus measures to start your strategic plan.
Yeah, and some of that is that sort of understanding of your customer and what marketing you've done. We are seeing instances where all of a sudden someone who's a potentially good customer is walking in the door and there's been no marketing to them, and we're encouraging businesses like that, saying, hey, are they coming to me because they can't get credit elsewhere. So sometimes avoiding that bad supply or sale is critical as well.
Yeah, absolutely. I have another question from Wendy. With Melbourne being the hardest hit city by COVID, which industries and sectors do you see bouncing back first?
Yeah, that's going to be a really hard question. What we can speak of is the experience we've seen externally, and we have seen as soon as entertainment came back, it bounced back very quickly. So as soon as people could go out into restaurants and pubs, etc., and that potentially is what led to what happened in Melbourne, we did see homewares and home-related products obviously performing very well. We haven't seen that so much in the second lockdown. I think that there will be a number of zombie companies. And Greg, what's your views on that? You're involved right in that.
Yeah, trying not to get to the negative side. I think deliveries is good. I suspect there'll be a massive push in for infrastructure. So probably not absolutely the shortest term bounce, but if you're involved in construction infrastructure in any way, shape, or form, or could be, I suggest that's going to be a great spot to be, because I believe federal and state governments are going to be throwing a heap of money into it. That makes sense on the monetary policy at the moment. It's been get money out in the community, and basically everyone can get some as long as you've got an ABN registration. I think it'll get more targeted, and that's an area that I think will grow, knowing that it's difficult at the moment, particularly in Melbourne, because I think they're only allowed a third of their people on sites.
Okay, great. And I have one last question. Unless, sorry, did you want to add something to that?
Yeah, I will say that that idea of zombie companies, we are actually seeing where companies are operating without sufficient resources, and they're relying on the moratorium we have at the moment, where there's nothing you can do to pursue it. I think it's going to be really interesting and something to be really careful of when you're doing business-to-business dealings.
And lastly, from Wendy, if you could make one suggestion to government re-stimulating economic recovery, what would it be?
My suggestion, Greg may have a different one, but I would keep JobKeeper going, and I would also keep JobSeeker at the higher levels, because what we've seen in the spending data that has come through from the credit cards companies is that higher income individuals have really stopped spending in this period. It's the lower income, normally lower income, that are spending a lot more at the moment. So the more we support those who need it in terms of don't have sufficient to save, etc., they will go out and spend. So I'd like to see the government keep on the idea of stimulus is to see it spent, not saved. We don't want it saved.
Believe it or not, Andrew, I'm not disagreeing with you. I think what we've done with JobKeeper and JobSeeker is fantastic. What I would like to see is an ability for commerce to recover their debts. At the moment, that's frozen, and I think that's actually affecting credit from financiers and banks because they don't have a recovery process. So I think if we kept the money going to people at the lower end, they'll keep spending, and then if you allowed businesses to recover their debts by not extending the temporary legislation, I think we get rid of the zombie companies, because my concern is you have a company that's not paying tax, and so it's got a 20% inbuilt margin, and it's bringing everyone else down in that industry. So that would be something I'd like to see, and it's a little self-serving, but I think that would be important too.
Yep.
I have another question from Annie. She has asked, for younger businesses that have just recently started, or for existing businesses that have recently implemented a new business plan, it may be harder to check if their strategy is working due to external factors. Do you have any tips about how to ensure and review your business plan during these times?
I think I really like this question because it goes to the heart, to me, of what drives success, particularly in smaller businesses or startup businesses. Too often we want to measure our success against a dollar factor, and as accountants, we're very prone to that. For smaller businesses, or startup businesses, write your business plan around activity. So instead of saying in 3 months' time, I want 10, my success will be 10 clients, you would say in 3 months' time, I want to have made 100 sales calls. Now, if you write it in terms of activity and you do that activity, you're going to give yourself a higher chance of success than if you set it to targets when you can't really understand what your targets are. One of the biggest things we see in successful business is self-reinforcement, setting goals and achieving them. So if you can write your goals in terms of activity rather than dollars, you give yourself the best chance of reaching those. And if you have some real thought behind what those activities are, and they're activities that will lead to success, you're increasing your chances of being there in that 3, 6, 12-month period, the dangerous period for new businesses.
Yeah, absolutely. Realistic goals. Being around, having built the base level of your pyramid that is your business. You don't need to maximise your return here. You just need to have a baseline of this will allow us to live and keep going, because we are just in incredibly difficult times. What I'm super conscious of, people who've got a base and are in business, when we move slowly through this, economic activity will increase, and you'll win by being around and having a full awareness of what you do when you're planning. So you've probably got time where you can't have as much not as much sales activity going on. Inwardly understand your business so that you're ready to take advantage of opportunities that come. And as Andrew said, it's a continual assessment process.
And I agree with you 100%. The longest standing, the survivors will be the ones that do well. Couldn't agree more.
Wonderful. Well, thank you both so much for joining us today and including your expertise. It's completely invaluable. Where can people find you?
We will send out our slide deck to everyone who's attended. They can look at our website, and in particular, Craig mentioned taking advantage of all of the government stimulus. We've got a whole bunch of free resources up there at rsm.com.au/coronavirus, or anyone can email me at andrew.sykes, S-Y-K-E-S, at rsm.com.au, and happy to answer any questions that pop up later on.
Wonderful. Well, as they said, they will be following up with an email. Thank you again, Greg and Andrew, for joining us today. And thank you, everybody, for tuning in. I hope everyone has a wonderful day.
Thank you.
Cheers all.